Welcome from me, Guy Monson, to our regular 6-minute strategy. America's tariff walls have not loomed so high in over a century. Just 12 months ago, the US maintained a trade-weighted average tariff of a modest 2.2%. Today, that figure has surged to between 22 and 24%, surpassing even the protectionist excesses of the 1930s. Meaningful discussions are now underway, it seems, between the White House and most major trade partners, including, we think, China. A flagship announcement of a UK deal is likely today. While the final agreements will almost certainly temper tariffs from today's levels, an outright dismantlement appears very unlikely. We will look at where tariffs might land and what this means for the global economy and your portfolio in the slides ahead. So let's begin by looking at financial markets for the year to date. You can see on the left-hand panel there, global equities, from a year ago up around 4%, but off quite sharply from the peaks we saw in early February by about 8 or 9%. Now I've used this here with a sterling base, so that incorporates the effect of a much weaker dollar falling against the pound for the year to date by about 6%. So that's what's dragged a lot of that overall return down. On the right-hand panel, in terms of leadership by style, that great growth drive we saw in Q4 of last year, giving way to a big rally in value and dividend yield styles, those are all coming into line over the last few weeks, with no real directional trend for any one underlying style. In terms of volatility, we've seen the markets much better behave, that US VIX falling back to 23%, close to its 20-year average of around about 19. Yes, we peaked at around about 50, and this was a severe shock to markets. But to be clear, it's nothing like the numbers we saw in the great financial crisis or in the COVID shock. Looking across other asset classes, that dollar continues to weaken, as I said there, off about 6% for the year to date, and against some currencies down by even 9 or 10% from its peak 3 or 4 months ago. Looking at that red line at the center of the chart, oil prices continues to weaken, off almost 27% from a year ago, with WTI today trading below $60. That on the face of it is disciplinary measures by Saudi and OPEC Plus on Iran and Kazakhstan, who are consistent overproducers. But it's also enormously helpful to Mr. Trump. It'll keep a lid on consumer price inflation because of weaker pump prices at just the same time as his tariffs are putting up prices elsewhere. And the bottom line there, gold, still continuing steadily to climb, with interestingly more ETF buying on top of purchases from central banks. So let's look at what these tariffs might land at going forward. Now, I'd love to say they're going back to zero, but I can think a complete return to pre-Trump era is simply not likely. We see Canada and Mexico tariffs, if they're under the trade agreement, the USMCA, at 0%, outside probably at 25%. Friends of the US, UK, India, Australia, Japan, South Korea, etc., probably tariff rates of 0 to 10%. We'll know more as they announce the US free trade agreement, most likely this afternoon. China proxies, Vietnam, Cambodia, Malaysia, and EU, where there is some real desire by the US to bring down that deficit, probably at 10 to 20%. And China still a high number, 50 or 60%, with probably broad bipartisan support for those sort of numbers. What does this mean for financial markets? Well, volatility will remain high. I'm afraid Trump policy is always going to be fluid. The US dollar should rally a little bit in the short term, and then I think it'll renew its depreciation as these tariff shifts become clearer in terms of their impact on US growth. Powell is probably right, lower growth and higher inflation. That means rate cuts will be less rapid than they would otherwise have been. And of course, geopolitically, the end of multilateralism. Great power competition, but yes, some benefits. Trump, perhaps the peacemaker, as we've seen with the cessation of rocket fire in the Red Sea after his bombing campaign against the Houthis. So let's look at the impact of tariffs to date on the US economy in real terms. Certainly the surveys look pretty grim. The Conference Board at the University of Michigan there show consumer confidence weakening almost to COVID-style levels. And on the right-hand panel, we've seen an enormous surge in inflation expectations. US consumers really worried about the tariff impact on their wallet. But look at the real economy data, as Powell encouraged us to do. And you've still got an economy that's growing at a solid pace. Payrolls are robust. Consumer disposable income is robust. And certainly in stock market terms, we're actually seeing record share buybacks in April, which is extraordinary. So what does this mean for interest rates? Well, likely cuts will continue, but in the US they will be slower. And I think Mr. Too Late, as Trump likes to call his Federal Reserve chairman, will pause, but we'll still likely to see 3, perhaps 4 cuts in the remainder of 2025. In the UK, we're going to move faster. We've had a cut today. We'll likely get one again in June. That'll be 2 consecutive cuts. We haven't seen that outside of COVID since 2009. And further reductions likely for the ECB. And on top of this, of course, liquidity measures to help stabilise the Chinese economy. So the liquidity backdrop for investors is actually quite attractive. So what does this mean for your portfolio? We're neutral in government bonds. We like a UK government bond yield around 4.5% today in the face of falling interest rates. We're underweight corporate still because the spreads seem to us very narrow. In equity markets, we're running a modest underweight, keeping a little bit of dry powder just in case these earnings revisions come in more aggressively than expected once companies are able to model the tariff effects. In alternatives, we still like our big gold positions and see value in the relatively high-yielding infrastructure positions. Finally, we're holding a precautionary cash balance just in case these Trump tariffs hit earnings harder than expected across our various themes and companies. Well, I hope that's helpful. I hope it gives you some idea of where these tariffs might land, what it means for the US and global economy, and what it means for your portfolio in the months ahead. Thank you.